Investors have been on edge as tariff threats, geopolitical tensions, and recession fears create a complex and volatile trading environment. But my next guest says it's important to manage risk, but you should also be on the lookout for signs of opportunity. And he's got some interesting charts to help illustrate his point. Ben Gossack is Managing Director and Co-Head of Global Equity Portfolio Management with TD Asset Management. He joins me now in studio. Nice to see you.
Yeah, really nice to see you, and I always look forward to our discussions.
As do I, because you bring lots of pictures, and I do like the illustration that comes with the conversation. And you got a bunch.
Yes.
So I want to move with intention as we go through the conversation. The first chart we want to bring up is to talk about what's happening in the markets right now, because there's how we feel, there's the headlines, and then there's actually what's going on.
Yeah, so I thought we'd start with the S&P 500. That's the big, broad U.S. index. We're going back to just before COVID. And what people are seeing on the bottom half of the chart, these sort of red shaded areas, are the drawdowns from the previous highs. So in COVID, it took us 23 days to fall about 35%. And then in 2022, when we worried about the fears of a recession, when we had zero interest rates and we were on a pace to go to 5.5% interest rates, it took almost 200 trading days to fall just shy of 30%. So, it's one thing to fall very rapidly, and that's very scary. It's another thing to descend over 200 trading days, and it's just like, what are we doing?
Tenth of a thousand cuts,
with a few bear market rallies.
Yeah.
And then in this instance, with the trade wars that are going on right now, it was about 33 days, we fell about 20%. So I do like to look at this to understand in hindsight what's been happening. And I would say the market is sort of taking a little bit of what they experienced in COVID and also a little bit of what we experienced in 2022 when we were worried about a recession. And so I'd say lately it's been a bit more like COVID. So something external entered the event-driven entered the complex system, and there was a reaction to it. Now, difference this time around versus last time, there is no sort of money coming in from the government to stimulate the economy, to support it as we dealt with the virus, similar to central banks, not flooding the zone, providing liquidity. What we're having right now is we introduced, tariffs or what could be, reciprocal tariffs, and then we started to walk back many of those sort of guidelines. Yeah. And so that in a way is similar to COVID, where we've had stimulus and the fact that we've sort of talked back some of these tariffs.
And one hopes that eventually gets talked back to a point where things are moving in the right direction. We will see.
We will see, yeah.
Yeah. Volatility, though, you say, has been something that we've had to get used to. But again, you're giving some historical perspective with this chart if we bring it up.
Yeah, I think it's really important because typically, we'll look to the VIX index. That's our big measure for volatility. On average, we're about 20. And so in COVID, we spiked to about 80, 85. We had a bit of a spike last summer. There was a dollar-yen currency unwind. It happened over the Olympics. Most people didn't notice. It started on a Monday, ended on a Friday. And then similar, after Liberation Day, we had a big spike. I get a lot of people telling me, oh, the markets are acting crazy. This is not normal. But a rule of thumb that I use, so the VIX index is an annualized number. So we say it's 35 or it's 32. That's a percentage, but it's based on the next 30 days from today. If you want to break that to a daily implied move, you divide by 16. So that adjusts for the 250 calendar days. So if VIX is 32, you divide by 16, you're looking at 2% implied move. So if if the market's sold off and then it rallies 2%, again, it's not anything unusual. That's just what happens in that type of volatility regime.
You're very calming. I should talk to you when I'm watching these things and we're going through it. Okay, we've got about 30 seconds here, and you've got a chart here showing that there's been a shift, maybe in what investors are looking at, a shift towards value.
Right, and this is where history rhymes, it never repeats.
Yeah.
We've tried to circle it, but during COVID we saw a shift from growth to value, short-lived, and then in 2022, again, 200 days of a drawdown, we saw a major shift from growth to value. And what everyone is looking at here, it's a tug of war between growth stocks and value stocks. We're looking at the Russell 1000. And what they can see over time, growth has outperformed value. And in this recent drawdown, we have seen a shift to value, but we've come at sort of a détente. And so there are possibilities where we could see a resumption of growth. Again, it depends on tariff negotiations and what is the ultimate measures that we're going to see.
Let's turn to the Canadian banks. You were talking about just to put the volatility and the market performance in historical perspective. Now it's time to put the banks in historical perspective. And we've got a chart here. We can take a look at the Canadian banks and tell me what it is that's interesting to you about this chart.
Right. So I'm really trying to understand the effects of tariffs and trade war and what it's going to do to financial assets in the economy. And I do look at the banks as being financial intermediaries. So this is a ratio chart. On the numerator is our equal weight Canadian banks, and the denominator is the TSX 60. And so if the chart is up and to the right, it means the banks are relatively stronger than the TSX composite.
Yep.
And so what I'm looking in terms of using the past as a guide, in 2014, 2015,
where you've circled here, yeah.
Exactly where I've circled. Oil fell to $26. Many of our oil and gas stocks in Canada sold off because that's quite a low price if you're an oil and gas producer. But also the Canadian banks also sold off because they make lots of loans to the oil and gas companies. Mm-hmm. So you can see there was a period of underperformance and then there was a recovery. Clearly in COVID, we're worried about the entire economy, so banks are going to relatively underperform. And then we saw a recovery because, again, the governments and central banks provided that support. And then as we entered into 2022, we were worried about people taking out all the loans when interest rates were zero and money was free. And then we made a pivot in about November of 23. I would say banks still have relative outperformance, and they have yet to capitulate, even though there is a lot of fear in terms of what U.S. tariff policy could do to the Canadian economy. Mm-hmm. So the fact that they haven't actually capitulated, and I've been in many meetings, I'm sure many people across the country are discussing different stocks that they want to own and concerns about X and Y, Z and what's going to happen in the economy, and yet our banks, I would say, still have relative strength.
Okay. Now, you've also brought a chart of what looks like when a sector does not have relative strength. And let's bring up this chart, and this is looking at the title of your chart, what relative weakness actually looks like.
Right. So if people are looking at our bank chart and they're saying, well, if that's not relative weakness, then what is? So this is an example of the communications sector in Canada. It's effectively the major telco companies. And what people can see is that it's lost relative strength to the Toronto Composite Index since at the very least 2020. It's just been rolling down a hill. And there are many different reasons for why that's happening. But from my perspective, it's very capital intensive businesses, big balance sheets. We're worried about prices going down when we have competition. So yeah. I've made this massive investment. I'm supposed to recoup it on the monthly payments that you and I make on our cell phone plans. Can we do that if there's going to be a price war?
Yeah. Let's take a look now. And again, a lot of people have been talking about, I remember at the height of when things first got announced, April 2nd, in terms of the new tariffs. And I remember listening to some European hedge fund managers saying that they thought the U.S. was basically uninvestable now. So you have to look somewhere else. We'll see. I mean, that's a moment in time. You got a chart here showing that this is the equities out, everything in the world except the U.S.
Right. So yes, we have seen a weak U.S. dollar. We've seen rising interest rates, people talking about using the U.S. as a funding source for a million other ideas outside of the U.S. borders. Again, we're looking at a ratio chart. This is going to be the S&P 500 as our numerator, and we divide it by the world ex-U.S. And what you've seen for quite some time, the U.S. has been outperforming the rest of the world. And this is why when most people examine a global product, they typically find 75, maybe 80% US content, because if you were the manager of the product, well, where was all the alpha and the performance? You were finding it from the US and probably technology companies. Mm-hmm. We've been through this before. So that 2022, we saw a shift to value. Europe tends to screen as value, and that's that first circle on the left. There was a shift, and people talked about selling their US, going into Europe. That was a bit short-lived, and by 2023, we were back to US, and then we were talking about AI and US tech dominance. Maybe there was an overshoot at the end of 24, but there has been a shift back to everything outside of the US. And we'll see where that goes. But I wouldn't say that this chart has completely shifted that all of a sudden it's never US. But it is something I'm monitoring.
And on that, the same theme, let's bring up the next one you have here, that you say that Europe is actually not a new trade. People had done this before, and well, I'll let you say it and tell us what you're seeing versus what the headlines say.
So in that world ex-US, I'd say 40-45% is European content. Europe is now the new shiny object. Everyone's talking about all these great ideas. But what I find interesting, Kim, is that there are if we break up the index into 11 sectors, there's two, and one in particular that we're showing here is financials, are the only ones that are actually outperforming in Europe. And what I really want to highlight here is, while everyone is talking about Europe in 2025, European financials have been outperforming the MSCI EFI, so this is the broad international developed index, since at least 2020. There are various reasons for why this is happening. People had effectively abandoned European banks due to the financial crisis, the European sovereign debt crisis. The regulators wanted the banks to hold more capital. They also tried this thing called negative interest rates. That didn't really work. And then the banks have overcome all that. And at the end of the day, as a shareholder, you're looking for share buybacks, dividend increases, and the European banks and the European insurance companies have been able to provide that. But that's not a 2025 story. That's like a 5-year story. Going beyond that.
Yeah. So where's the strength? We want to talk about that. I've got about 2 minutes. I just want to make sure we get them in there. So this one is talking about what is working in Europe. Right.
So if we break it up into 3 buckets, so we talked about the financials being a source of strength, but again, something that's been going on since 2020. Since 2022, the European industrials have been a relative outperformer. It's come from a few areas, one being industrial products for the data center. Commercial aerospace has been, especially maintenance repair, has been very profitable. There's a lot of companies in Europe that provide that. And then would say more recently, the European defense contractors have also started to pick up and carry the baton. But from my perspective, again, 2 out of 11 sectors are what's getting people excited about Europe, but that's not they're not from 2025.
I've got about a minute, and I want to, because this is kind of the now what. So given this, take us through this last chart and tell us why this one is interesting.
So obviously we've seen a shift to Europe. We've seen some U.S. underperformance. A lot of that has been driven by U.S. tech. I know everyone likes to measure everything by year-to-date and calendar returns. Again, I think that's a bit myopic. U.S. tech has actually been underperforming since August of last year. We've seen the semiconductors and software companies have been underperforming. Again, this is a relative chart, so tech over the S&P 500. We were almost going to take out a period of resistance from 2021, but it was, at this point, looks like a failed breakdown, Kim. And if it is a failed breakdown, we typically get fast moves in the opposite direction. And we have seen companies like a Microsoft, and various other tech companies report good results. And this could be the beginning of something where we see a renewed strength in U.S. technology, which may shift the discussion back from Europe back to the U.S. of A.